Welcome back to the PACE Global Advantage Weekly Report. This week we are speaking to international tax expert Gregory McNally. Greg will be discussing tax issues in Switzerland, the Caribbean, the Channel Islands, Asia, and the Independents. Greg, there are currently talks between the UK and Switzerland. There may be an agreement that will see undeclared accounts held by Britons in Switzerland taxed. There will also be more information shared between the two states. What are your thoughts on this proposed cross-border cooperation?
Well, this is part of a specific initiative by some of the stronger G8 members, the UK, Germany, and the United States, to try to get more transparency out of Switzerland and some of the international financial centers. The goal of these tax countries is to get the tax it's owing from their resident taxpayers, but at the same time, they don't want to impose currency controls in their own nations, which would ultimately undermine their own economies. Switzerland's goal is basically to keep bank confidentiality as part of one of the main pillars of their banking format, which they see as really important. The upshot of all of this is a compromise. Switzerland will agree to withhold taxes on their offshore accounts for these particular nationals unless the taxpayer or the account holder agrees to voluntarily disclose the existence of the account to their tax administrations back home. So if these accounts really don't owe tax, then there shouldn't be any problem in disclosing. If they do owe tax, then they're going to have to pay the equivalent of 25 to 30% on the balance of those accounts, which is pretty significant.
While we are on the subject of Swiss banking, I'd like you to comment on the recent announcement from the Canadian government, specifically the signing of a protocol to the existing double tax agreement it has concluded with Switzerland. Will dividends be exempt from the withholding tax?
Well, the Canadian negotiations were slightly different. They weren't looking for this withholding tax platform. They were negotiating along the format of their existing tax treaty with Switzerland, so it followed the OECD format. And in that regard, what Canada was really after was the exchange of information on specific individuals. In the past, Switzerland wouldn't agree to exchange information on individual bank account holders. Now, under this new protocol with Canada, and this is the format that's followed in the OECD model treaties, when a tax country comes to a treaty country with a specific request for a bank account or an individual, that country's obligated to provide that information. So that's what Canada was after. But also, Canada is allowing Switzerland to basically act in an institutional format. The dividends concept is where you have investment from pension funds based in Switzerland in Canada, and Canada will allow zero withholding on those payments back to Switzerland. So what we're seeing is an evolution, I think, in terms of what the OECD countries will allow these international finance centers to do. And that is that they'll allow them to act in an institutional capacity, pension funds, insurance business, hedge funds, but where they don't want them to go, or what they're trying to curtail or bring back, is private client bank accounts, and the days of secrecy are over.
There are talks that the Caribbean tax haven jurisdictions are turning into a case of the haves and have-nots with respect to keeping up with new pressures from the OECD. Can you comment?
Well, in the 1990s, these smaller countries in the Caribbean and around the world were looking for ways to diversify their economy. So what they did was they instituted some legislation providing for bank confidentiality. In the late 1990s, when the OECD started to put pressure on these countries worldwide, the more developed or sophisticated international finance centers started to put in place infrastructure that would facilitate ongoing business in the future. So Cayman, Bermuda, put in place some banking and some very sophisticated law firms that were there, and that helped push their business forward. Whereas other countries couldn't keep up with that sort of infrastructure, and more importantly, they didn't change their legislation to take advantage of certain loopholes that were developing post-OECD pressure. So the countries that don't keep up will basically not be able to go forward, and that's, again, primarily in the institutional realm as opposed to the private client realm.
Can you comment on the fact that a number of these Caribbean jurisdictions are influenced by the UK as official overseas territories and by the US and Canada economically?
Well, there are a few Caribbean countries, such as the Turks and Caicos, Anguilla, Cayman, Bermuda, that are overseas territories or dependent territories of the UK. Gordon Brown, after the G20 summit, came out and said basically that these countries had to come in line and they had to sign a minimum amount of tax information exchange agreements. At first, people thought that that was going to hamper their ability to compete in the international arena. But in reality, this is the way we're going. It's all about tax information agreements. It's all about enhanced tax treaties. So actually, it might have done them a favor because it's pushed them now towards where the future is going in any event.
The Channel Islands are another example of the UK and EU clamping down and forcing more transparency. What are your thoughts?
Well, the Channel Islands are slightly different. Not only do the Channel Islands have that pressure from the UK government politically, but they also have pressure from the European Union. And their back office is regulated by the Bank of England. There's some connections there. Maybe not directly, but there are some definite connections there. So they are in a little bit of a different position. What's happening with the Channel Islands, as well as I believe Gibraltar, is that the EU wants them to institute minimum corporate taxes. And that is an additional type of pressure that's on those jurisdictions that aren't on the Caribbean or the Asian jurisdictions.
Greg, we've talked about the push from the OECD for more transparency in the banking sector. Where's China in all of this? Is it true that China is going to be the new tax haven?
Well, I don't know that China itself is going to be the new tax haven, but definitely China is going to be involved in, the financial industry going forward. As we all know, they will be the next superpower. But right now, they have a number of currency controls to protect their economy as it develops. However, they are supporting certain jurisdictions that are attached to them or friendly to them. Hong Kong, obviously. Another one would be Singapore. So going forward, these jurisdictions, Hong Kong and Singapore, are going to be able to take over a lot of international finance business. They are definitely seeing a benefit of capital leaving, say, the Caribbean or Switzerland, because they are protected by China. The OECD can't put as much pressure on those jurisdictions. However, having said that, Singapore and Hong Kong are following, again, the format of tax treaties worldwide and tax information exchange. So while those jurisdictions will do very well going forward with the protection of China, they're going to follow along the agreed format that I think the world is going to.
Let's finish up with your thoughts on how the independents, such as Dubai, Luxembourg, and Panama, are dealing with the pressures from the OECD. I understand Luxembourg has sold bank data to Germany. What do you think?
Well, some of the independent international finance centers are quite interesting. I mean, they are able to carve out their own agenda due to their own unique geopolitical situation. So Panama is a good example. They have the canal. Dubai, obviously right in the middle of the oil and gas, major oil and gas area of the world. So these countries are going out there and they're seeking specific concessions to allow them to do business on behalf of the developed nations. Luxembourg is another good example. Now, Luxembourg has had treaties for a long time, but they are right in the middle of the Liechtenstein, Switzerland, the whole banking sector there next to Germany and France. So as you can imagine, they're getting a lot of pressure. And Germany is actively recruiting individuals to sell them information. So that's been happening from employees out of banks in Switzerland, Liechtenstein, Luxembourg. Luxembourg has been very clever, though, in that what they've said is, okay, fine, we'll agree to automatic exchange of tax information, which they've never done before, if they are granted a concession in terms of hedge fund and pension fund legislation. So what they want to be is they want to be the go-to place for hedge funds and for pension funds. And if the developed nations will agree to concessions favoring Luxembourg, then they'll agree to automatic tax exchange. And that's very similar to what the other independents are doing. Panama is negotiating treaties now. Dubai is negotiating treaties, and they're looking for specific concessions that will allow them to continue on as international financial centers, primarily, again, as I mentioned before, in the institutional realm as opposed to the private client realm. But that's how they're able, basically, to keep their financial industry going in the future.
All right, Greg, thanks for joining us. We'll see you next time.
Thank you.
Everyone else, please visit paceglobaladvantage.com for more business news and information.